Okay, good afternoon, everyone. Lovely to have you with us today. I'll just see the time tick over 4 o'clock Singapore time, so I think we're good to get started. So welcome to another SITBA webinar event. Today's event is titled Investments, What is Happening Now and How Can It Play Out Over the Long Term? My name is Dr. Jacob Wood and I'm the Associate Dean of Research here at JCU Singapore. Today, I'm delighted to welcome my good friend, Haresh Raju from JP Morgan Private Bank. But before I formally introduce Haresh, I just have a couple of quick housekeeping issues that I'd like to go through with you first. Firstly, the webinar will be recorded for publicity purposes. Attendees will be able to ask questions at any point of the webinar through the Q&A function. And I was just chatting with Haresh earlier. He's happy to take any questions as they come in. But if you don't want to do that, then there's always going to be a Q&A session at the end of the presentation. There will be a satisfaction poll and survey at the end of the webinar. And if there are any technical issues, please use the chat button to communicate with the event organizers. So, as I mentioned earlier, I'm delighted to welcome Haresh here to JCU Singapore and to the SITBA webinar series. To give a little background on Haresh, I'd just like to say that at present, he is a global investment specialist at JP Morgan Private Bank, based in Singapore. He provides discretionary and advisory investment management services across equities, fixed income, currencies, and alternative assets to clients in the region. Haresh has spent more than 18 years in financial markets across investment advisory, treasury advisory, and fintech. He holds a master's degrees in finance from universities in India, and he is a CFA chartered holder and a financial risk manager. But before Haresh starts his presentation, given some of the big developments that occurred overnight, I was wondering if Haresh would like to provide a little bit of your thoughts around the Federal Open Market Committee decision to raise rates by some 75 basis points. What are your thoughts about that decision?
Absolutely. I mean, couldn't have asked for a better time, right, to share what's happening in the markets after the overnight FOMC meeting. Yeah, like you rightly pointed out, 75 basis point, the first time that they've done it since 1994. Very clear reaction to what happened with the CPI print that came out last Friday. So the interesting thing is, before the CPI print, the probability of a 75 basis point hike by the Fed was, I think, 5%. And as soon as the print came out, and the market chatter started, the market priced the probability of a 75 basis point hike to 95%, and the Fed delivered, right? The Fed couldn't stay away from what's happening in the inflation. So a lot of underlying inflationary trends that they want to kind of be a little ahead, given that they were, pretty behind with the whole transitory kind of view that they had to inflation in the past. So this is a way for them to kind of stay ahead and see if they can combat inflation head on. So the main important thing, I think, was the fact that apart from the fact that the hike came through, there was a statement, or there was some wordings in the statement which basically mentioned strongly committed to returning inflation to its 2% mark. So this is a different kind of language that they've used compared to what happened last time. So all in all, the other interesting thing for me that stood out was the hike of 75 basis points came when they kind of put the unemployment number up, and they also revised down their growth expectations. So it is a tough spot for them, and they are staying ahead and trying to stay ahead as much as possible. But yeah, it will be interesting to see how it played out. The market liked it after the initial sell-off. I think they kind of accepted it, and then
the US dollar strengthened, I saw, after the announcement.
Yeah, absolutely. And the dollar is a big differential in the way there's a lot of risk aversion flows coming to the dollar, but also the fact that yields are running up so fast that a dollar becomes the place to be.
Yeah. Yeah, no, very timely, your presentation based around, the news overnight. So I guess, without further ado, Haresh, the floor is yours, and you feel free to start your presentation.
Sure. Thanks so much. And I thank you for the opportunity to come here and talk about how we are looking at markets. What I will do is trying to give you a sense of what's happening right now in the market across different asset classes. But I think also we'll try and put in perspective that we are going through a lot. It's not a normal correction that we are going through across different asset classes. We'll also try and put in perspective what are the things that we need to keep in mind as investing principles for the long term. So I'll keep going through it, but in case there's anything that comes up, any questions, please feel free to kind of stop me, and then we can take it from there. So, I think all of you would be knowing it's been a tough year, right? 2022 has been a year where there has basically been no place to hide. You look at equities, you look at bonds, cash is kind of the only place that has generated a decent amount of returns given the amount of rate hikes. But equities have suffered, so have bonds overall. All of that can get pointed out to inflation as a problem, because there has been a ton of demand, a lot of money that has been given into the system post the pandemic. There was a lot of fiscal support also, where government were also giving a lot of these handouts, as you know. All of that has created goods inflation, and services also picking up with the whole reopening that's kind of happening. Expansion is continuing. So if you look at the chart on the right bottom, the expansion is continuing, but the pace is slowing down, and that's probably something that you would see as in many of the slides that come through, that the expansion has been strong, but the pace is slowing down, and that's what we kind of have to keep a close watch on. For 2022, if you look at the market, as I mentioned to you, commodities has been the only place where returns have been positive. All of this is because of energy, and there are a lot of things happening on the energy side. When the Ukraine-Russia war has only kind of exaggerated the kind of issues that the energy market is facing, with oil prices going up. We've spoken about this multiple times and you'd have heard it from a lot of the news channels also, that as we got out of the pandemic, there was extremely strong demand last year, if you see, and all of that has led to some pain points, right? If you see, inflation is still running hot, the chart on the left top, which is basically it's on the back of supply chain. If you see the chart below that, the supply chain issues have not yet been completely sorted out, right? There are slower deliveries that are happening, and because of which there is an inherent price pressure that we are feeling, and all of us, I think most of us are feeling it in our pockets also, right? I was just having a conversation with my wife yesterday or day before, and what used to be a normal visit to Fair Price, where we technically know what we buy during the month, if you're paying, say, $100, we've ended up paying about $150, $160 also sometimes, right? So it is there. Supply chain concerns have not yet been taken out, and which is also leading to that pain that we are seeing with our spending. Labor market is also an important is also extremely important, because the Fed watches it. The Fed has basically two mandates, right? One is inflation, which is price stability, and the other is maximum employment. So when the Fed is looking at the labor market, they want the labor market to do well, but the Chair Powell has mentioned in the previous meetings that it is unhealthily good. You see, they want the unemployment to hover around 4%, but not at the say probably 3.5 or 3.2% unemployment rate, which they feel that it is extremely tight. So fundamentally, what happens is, when you have a tight labor market, or a way to say that the unemployment numbers are low, wages kind of go up, and wages kind of feed into inflation. So that's the kind of connection that you can kind of think of. Consumer sentiment is poor. Interestingly, I think yesterday Chair Powell also mentioned about this. There was a survey that came out again last Friday, in fact, University of Michigan's Consumer Sentiment Survey, which basically mentioned that the first of all, the sentiment came in at almost an all-time low, and then on top of it, the forward-looking inflation expectations by consumers also came in at a very high level, and I think that kind of tilted the committee's inclination to kind of go for this 75 basis point hike. So this is something that again I would say one of the effects or the side effects of the amount of stimulus that we have seen in the market, right? Like the Fed has pumped trillions of dollars into the economy in response to the pandemic. The fiscal support, which is the governments also were more than happy to kind of give those handouts to people. So if you look at broadly, like I'll probably point you out to the chart right on top on the left, which is basically households still have excess savings, and which is what we are seeing, right? A lot of people in the US have a decent amount of savings from the pandemic because they didn't have too many avenues to spend, and that is also coming into the market as this pent-up demand, right? People just want to get out and about and travel, and which is what we were expecting those prices of the goods to kind of come down and services to pick up, but that handoff has not happened in the way in which we would have expected, because consumer demand is still strong, and which is what is trying to get addressed with these rate hikes. Corporate debt, if you were to look at the other part, the chart on the right side, basically says that the corporate debt service cost is at multi-decade lows. So fundamentally, think of it that during the previous crisis, the global financial crisis, corporates were a lot more levered, consumers were a lot more levered, but we are seeing the other way now, and which is what is leads us to our conclusion that the expectation at least is that we might not see a full-blown recession, or the probability of a recession is low at this point of time, but the risk of that recession is going up as we see, or in the last couple of months, is the risk of the recession has gone up a lot. So where are we in the cycle, right? I think that's the big question that all of us have. Are we hitting recession? How soon are we going towards it? Or what part of the cycle are we in? So this slide, I mean, it's a busy chart, but all I would like to make a point, maybe you can just concentrate on the chart on top. The table is just some details about the chart, so we basically came through the V-shaped recovery, right? During the crisis, you would have heard many people talk about different kinds of alphabets. Some said U, some said W, some said K, those kind of recoveries that people were talking about. But as you can see, it is a V-shaped recovery, and a pretty steep V-shaped recovery. So think of it that the perspective for us over here is we went from early cycle, we went through mid cycle in a hurry. We're already in late cycle right now. And what are some characteristics of late cycle? We will talk about it in a lot more detail, but we are seeing price inflation much above Fed target. Fed target is 2%. Inflation is printing at about 8.6% most recently. Unemployment number is near, or it's actually below the Fed's target. So we have rushed through the mid-cycle. We are at late cycle right now, and those are the kind of dynamics that we will be taking out and seeing how do we position ourselves, from an investments perspective in this late cycle. So as I think we have seen this, as I mentioned to you, right? Economic activity is decelerating. If you see the orange and the blue lines, which is of the US and the UK and even the Eurozone, the brown brown line. All of that is kind of turning down a little bit. And, we have seen that play through over the last couple of months. China, on the other hand, is going through a different thing, right? With the whole zero COVID and other things that they've got, that they're going through right now. In fact, this month and last month, we've seen a little bit of that recovery coming through in China, because they went through this decelerating phase a little earlier because of their COVID strategy. Anyway, on the lockdowns in China, just staying with that, if you see a lot of the activities around China, all these sectors have had a big impact, right? If you see in the orange lines, April 2022, the amount of activity drop in housing sales. So for perspective, if I were to, the property sector, it makes up about 1/4 of the Chinese economy, and 70% of the wealth in China, the household wealth in China, is in the real estate space. So it is a very important segment or sector, if you were to look at it, and you can see the amount of impact of, the amount of activity drop that we have seen. But interestingly, if you look at the exports, which is the bars on the left, the left corner, they kind of have held up. So China has generally done this over the last, even through the pandemic, right? They've kept their factories open, made sure that they've, at least some part of the supply chain. There is a disruption, but they've tried to keep it open and supply goods and to different parts of the world. But obviously, the pace and other things will take an impact given their restrictions. Commodity prices. So all of this has led to the zero COVID policy, the war in Ukraine. All of that has led to commodity prices, really going up. So prices have shot up 30%, and even in this year, the BCom in this, which is the Bloomberg Commodity Index, that has also kind of shot up a lot. So, and it was left to energy, but then the war kind of put wheat, corn, and all of the other parts of the food chain under pressure as well. So those prices have gone up. The base commodity prices have also gone up given the amount of demand for goods and go through the pandemic. So people started producing more, having inventory buildup has also happened over the last couple of quarters. So generally, there has been a big demand for commodity, and which is what is getting reflected in the commodity prices. But more importantly, that kind of feeds into the prices that we pay as consumers for the goods that we look to purchase. Yeah, so this chart, I think it's a very known thing. One of the main areas of concern with the Russia-Ukraine war is the amount of dependence that Europe has on oil and gas, natural gas from the Russian economy. And so this is an important distinction to make in our minds when we are looking at Europe and what's happening there, and US and what's happening there with inflation. So Europe is more of a supply driven, right? Because of the amount of dependence that they've had, the amount of disruptions that this has caused, and the prices of natural gas and fuel and oil has generally gone up. That has had an impact on consumer, how the consumer spends, right? And because of which we're seeing energy as a big component of the price increase or the CPI impact in Europe. So it's more supply driven, but in the US it's a little more balanced if you were to look at it from that perspective. So yes, there are supply chain disruptions, but because of easy money and because of just general demand side pressures, also wages have been up. All of that is also kind of contributing to. So I think when you look at inflation, we can probably talk about it a bit more in detail, but yeah, this is something that I think all of us are, concerned about now with inflation and all of the impacts that it has on our daily lives. But one distinction would be the amount of dependence that Europe has had on, oil, and all of that is kind of playing out.
Haresh, I've just, as you're going through this, it just reminded me of some discussions that I've seen in the media in New Zealand about where the blame should lie in terms of inflation. How much of the blame rests with the government itself, and how much blame do you think rests with, factors like supply chains and the war in Ukraine?
Well, great question, Jacob. So, it's really a difficult thing to pinpoint. The problem was that I think everybody was a bit anxious about what the pandemic kind of brought onto us, and I think with the just abundance of caution that everybody wanted to take, which is different from what happened to the GFC, right? Because we had quantitative easing 1, 2, and 3, and this was and there was no much of fiscal support, right, during the crisis also. But now, when the coronavirus kind of hit, the COVID crisis hit us, the monetary policy did the summation of QE 1, 2, and 3 at one shot in 3 months. And then you had the government coming and doing the handouts and what you call a lot of those benefits that were given to consumers. So that basically put cash on your hand, right? Which is very different from giving easy money, and that kind of feeds into asset prices a lot more, so equity and other things. But if you put cash on my hand, there's a higher tendency for me to go and spend it somewhere, and which is given that pressure on goods. So unfortunately, what happened is this COVID, the China zero COVID policy is not kind of going away, and then you had the war that's happening, so which has kind of put a lot of pressure on it. So I wouldn't say it's difficult to say whom to blame, but the confluence of everything that's happened, is not something that is normal, is what my sense to that would be.
And I guess just to quickly wrap up, because I know you've got much more to go through, but I guess there's good spending and bad spending from a government perspective as well. So I guess if it's targeted well, then maybe it's okay. But if it's just, spending for the sake of spending, then, maybe that does have pressure.
Absolutely.
Yeah.
Absolutely.
Okay.
Thanks for that, Jacob. Thanks. So I know, and just staying with inflation, right? And like as you can see, a lot of the it's been a very sharp move from the usual 1.5%, 2% kind of places of inflation, and that was something that we saw for a long period of time, to almost the 8.5, 8.6 kind of a print. It has been, a lot of things have contributed to it. I'd like to just make one point over here is shelter, which is basically rental and owner equivalent rent for people. That's how it is calculated, because you have people staying on rent, paying rent, but if I own my house, then what is the notional rent that I would pay for the place that I'm staying? So, and with prices going up, the rental inflation, the shelter inflation, as you call it, or shelter component, is also been contributing to the higher inflation. And generally, you look at it, it's the stickier part of inflation. You would think that goods, as we got out of the crisis, goods inflation could get handed off to services inflation, and then inflation could kind of cool down. But that handoff has not happened in the pace at which the market was kind of anticipating, and because of which we are seeing those higher prints on the inflation still being still coming through, which is what led to the Fed 75 basis point hike. There is a component of wages as well. I think I have a chart on wages as well. Yeah, right here. So I think of wages also to be a very important component in the final inflation. Very simple relationship in our minds that we can have is, more wages gives me more purchasing power. And because I have more purchasing power, I'll go out and spend a little more. When I want to spend, there's more demand, and because of which prices can keep going up, and which is what is reflected in the inflation numbers staying up. So as you can see on the chart on the right side, in low, medium, and high cohorts of workers, they've seen their wages go up. The lower wage earners have obviously seen a much larger move up, because there has been this shift of moving from one job to another, and because of which job hopping has given them higher and higher wages, which part of that is getting reflected there. But and I think an important perspective that we need to keep in mind is the chart on the left, right? The US labor market is also healing in a decent pace. So if you look at the participation rate, what is participation rate? It is the number of people who are looking to work, the qualified people who are looking to work in the economy, and that participation rate is actually going up steadily, right? It came down all the way to about 80%. Now it's kind of climbed back up to about 82.5%. Still some time to go before we hit the highs of about the 83%, which was part before the pandemic, but it is healing fast. And the number of people not in the labor force because of COVID. So a lot of people were nervous, think of it like that, because and they were not part of the labor force, but they have been coming back into the labor force at a decent pace as well.
Haresh, I just had a quick question on the low-income learners' wage increases. Do you think that's also reflective of the fact that in places like New Zealand, for example, where the borders have been closed, a lot of the jobs that were filled by foreign workers, usually a lot of them would take the low-income jobs because they're simply not there. Is that also reflective of the fact that employers, to attract local market, have had to increase their wage offerings as well, do you think?
Absolutely. And, I think immigration being down, even in the US, New Zealand, as you mentioned, a lot of the other developed economies, immigration being almost, zero, right, during the last 2 years has contributed as well. And then you had the general participation of people coming back into the labor, because, think of it like this, and this was the research that I was kind of reading through to understand a little more of it. The government was giving so much of handouts that for a person to kind of motivate, or for companies to motivate people to come and work for them, they had to actually increase wages by a very large extent. And all of that had a ripple effect, right? And people were hopping jobs, and because the number of people were scarce, and because of which we've seen that kind of a spiral happening over there. Yeah, I mean, we've spoken about the central banks, and I think I just wanted to spend a little time on this. We are seeing Fed hiking, and how does it impact the markets is a question that always kind of comes to our minds, right? Like, okay, the Fed has come and hiked rates by 75 basis points. Like, how is it going to slow down inflation? How is it going to have an impact on GDP? Is a question that I thought this slide kind of brings that to life. So on the left-hand side, on top, you can see that the mortgage rate is actually trailing very decently higher than the 5-year moving average. So what does this mean? So it basically says that the mortgage rate has gone up so fast, so high, that it kind of incentivizes people to buy new homes, right? And housing, again, in the US is also a big market. Mortgage payments are have a decent impact on the way people spend and other things. So if you look at the impact of that, the chart on the left bottom, you can see that the mortgage applications have actually downshifted, right? So the number of people looking for mortgages have actually gone down. That feeds into housing demand. So we've seen housing prices come down as well. So all of these hikes that have happened is also having an impact on the amount of demand for housing. And housing demand has many ripple effects, right? It has effect on the number of you need to buy things for your house as well. There is that goods demand, and then you have services people coming to build it. So it has a big impact on the market as well. But if you look at US corporates, given the strength that they've had and the generally lower servicing debt that they have on their balance sheets, it will take a little more time, maybe because this is a bit dated and things are moving so fast. It'll take a little more time for it to really start pinching them, and that is something that we'll be looking out for. So this slide is basically to give you a perspective on during rate hiking, the rate hiking cycle, right? There is a general sense, I think, that a lot of us have that, when the Fed hikes, it's not good for the equity market, but that's not true actually. So if you look at the past cycles from 1982 all the way until now, there have been instances where, consistently and on average, the S&P 500 has kind of returned about 10% through the Fed hiking cycle. So one thing to keep a note when you're looking at this, and obviously the initial reactions can be bad, and then the market kind of accepts it, and you can see the market kind of recover. But one thing to think about when you're looking at this is, the Fed is not going to hike when the economy is not good or decent, if you were to call it that, right? So that's important, because when the economy is actually doing okay, when the Fed hikes to control inflation and to kind of dial back a little bit of the support that they've given to the economy, the equity markets tend to kind of grind higher. Okay, so this year, what has happened? I think because of the whole rate hikes that we have seen, the 25, 50, and 75 basis points hike that we have seen, all of the composition, if you were to look at the US equity returns or equity market returns, this year has been a story of multiple compression, right? So what do we mean by that? So when interest rates are low, people are willing to pay maybe a slightly higher multiple for valuations or for earnings that are going to come out in the future. But when interest rates are high, they generally would not have that patience to wait for that earnings to play out in the future, because they can get there are alternate ways of earning a decent yield currently, right? Like if you put your money in the 10-year or a 3-year or a 5-year, you're getting return of about 3.5% already. So whereas interest rates go up, generally valuation multiples compress, and that is the reason why we are seeing valuations kind of come down, or multiple compression being one of the main reasons why we are seeing equity market returns come down. So all of this has kind of brought down the valuations to long-term averages. In fact, we are seeing this to play out at a sharp drop that we've seen from the beginning of the year to now. Global equity valuations are kind of trading at around 15 times. Which is near the averages that we have seen in the last 20 years. So, and obviously the composition of markets of the companies itself has changed a lot. But nonetheless, from an average perspective, we are near. In fact, I think we would be near, because the sell-off that we saw on Friday and then Monday and Tuesday we would be somewhere near those 20-year averages. Again, a note of moderation. I think one of the things that we are looking at is the US, at least if you look at that dark blue line on the left-hand side, right? It is kind of staying on, and that is the reason why the at least the US equity markets, the earnings have not yet been repriced. We are still looking at earnings to remain stable, but there have been cautionary statements that we have seen from a lot of companies, consumer staple companies like Target, Walmart. We also saw statements from CRM, Microsoft a couple of weeks ago, where they said that because of the strong dollar, they can see an impact on earnings. So a lot is happening on this space, and something that we really need to keep a close eye on. So, just trying to put all of these things together. We are in late cycle. The consumers are strong. The corporate balance sheets are strong, but activity is kind of also slowing down. The Fed is aggressive in the market. So what does this all mean, right? And one of the things that we are kind of looking at is in the late cycle, as we call it, sectors tend to be less correlated. Now, what does that mean? When a new cycle starts, I think we can all think back in 2020, post getting out of the crisis, the COVID crisis, everything rallied, right? You had technology, you had unprofitable tech, you had profitable tech, you had healthcare, you had, all of the sector, consumer discretionary staples, all of it kind of mid cap, small cap, all of it did well. But as we come into the late cycle, sectors will start becoming less correlated. And what that means is basically we need to be very mindful, and active management starts playing a much bigger role in making sure that we are generating decent returns. So what we call is alpha, which basically means that we want to have higher returns. Beta is what the market gives you, but alpha is where we are looking to kind of generate that alpha through active management.
Yeah, just for the benefit of some of the students, what can you define what you mean by active management there?
Yeah. So active management is basically let's just take the US equity market, right? The S&P 500 is the index that a lot of people track. SPX is the index that that's how it is kind of that's the ticker, as you call it. Now, the way to invest in it can be just to buy the ETF, right? The SPY ETF is one of the ways in which you can buy into the S&P 500. But what we mean by active management is basically fund managers who identify specific stocks and put a portfolio together. So either through mutual funds or some other strategies that we can give to our clients, where they very clearly take a call on, okay, I want to have an overweight on this sector I would want to do that via these couple of stocks. Right? And it's a very clear way of putting a portfolio of 30 to 40 stocks together, and then use that as a way to kind of generate that positive return over and above what the S&P 500 would give. Right? And in that late cycle, you will see that play out in a much more pronounced way. This one is, again, making that point on rebalancing it across the sectors. So we are not looking at doing it, being very concentrated on one sector, cyclicals, defensives, and secular, but we are very clear on what are the subsectors that we are positive about and how we will position into those sectors itself. So one of the things that we are looking to actively do through this whole process is basically say that core fixed income is one of the highest conviction ideas that we have. What do we mean by that is basically the rates in the US, let's say the 10-year rate has gone up a lot from almost 75 or 50 basis points that we saw during the pandemic to about 3.5% right now. We see that gives a good way for us to earn the yield, but also be in a position to kind of generate that, add it into our portfolio to give that recessionary hedge. What happens during a recession is usually rates come down, and in the fixed income market, what happens is when yields rise, prices come down, but when yields come down, prices go up. So currently there is a bit of an asymmetry in that. So the example that we would like to use is that if the current is about 3.5%, if the rates were to kind of go down by about, say, 20, 40, 50 basis points, because of the inherent duration that you're having when you're holding the 10-year, the return can be positive. But even if the rates kind of stay in these levels or even go up slightly, the amount of impact that it would have is lesser. So effectively, we are saying that we are almost on top of that cycle right now, or we are at the top end of the range that we have for 10-year, and that's something that we are looking to add for our clients, because it kind of does the work of generating the yield, but also gives us that hedge against a recession if it happens. So our key takeaways, I think fundamentally is equity market volatility will continue to reign, but we believe bonds will serve as valuable portfolio balance. So as the same hedge thing that we spoke about, adding core fixed income through this is one of our highest conviction areas. Dynamic active managers and strategies are something that we are looking at, and inflation is something that we are concerned about, and it's not going away in the pace at which we wanted it to. Real assets, which is owning real estate across and commodities, are ways to kind of protect yourself against inflation. Yeah, so I think this is what I wanted to kind of lay out as what has happened now. Any thoughts, any questions? Happy to take it before we can close off with some investing principles, as I call it, to keep in mind as we go through this very difficult period.
Fantastic, Haresh. Really appreciate the presentation that you've just delivered. I've written a few questions down here as you were going through, and I can see in the chat there's quite a few questions, and I should have told you to bring your crystal ball, because there's a lot of people with questions around where they should be putting their money. But the first question is just in regards to, you were talking about the extent of, in terms of the US, what's the extent of valuation compression? Can you just go into a little bit of detail around that, and maybe just explain what you mean by that as well?
Yeah, so we've seen a decent amount, like I told you, like most of, the way you look at US, you look at the world equity indexes, most of that has compressed by about, the multiple has compressed from about 24 times that we saw to about, I think, 15 times now, the S&P 500. So that is near the 20-year average again. So what has really happened is we've seen that multiple compression happening at a pretty fast pace, given the whole rate hikes that we've seen over the past couple of quarters, which kind of gives us the opportunity set also, right? To be honest, because what we are seeing is the S&P 500's composition has changed a lot, right? We had a decent amount of tech, but we also have companies that are having a lot more free cash flow as part of the index. So when multiples compress like this, it kind of gives us that opportunity set as well for us to start, kind of probably nibbling in.
Okay. Just maybe building on that, just looking at the issue of drawdowns in reference to the SPX, does history provide, how much can you read into history around, drawdowns, and say if it was to, fall by another 10% in a bear market, what would that mean?
So
increase? I know.
absolutely. I mean, and something that everybody is concerned about now, right? Like markets are actually down a lot, 20% on the S&P 500, but can it fall another, you say probably 10% or whatever, right? So if you were to look back into history, it has happened. It has happened about, I think, 3 times in the past. One instance was during the November during 73, 74. So that was one instance where inflation had already run hot for a decade at that point of time. So inflation was completely out of, I would say, it had become unanchored, as you call it, because the Fed was trying to fight it, but they were not able to, and that led to the sell-off. The other instance was during the dot-com bubble, which is at 01, 02. At that point of time, obviously there was a lot of unprofitable tech companies who were trying to list themselves at insane valuations, but that didn't play out. The big difference now is obviously tech is a big part of our investing universe, but there is a lot of profitable tech also, and most of these tech companies generate like tremendous amount of cash flows. The other most recent is during the financial crisis, right? The global financial crisis, 08, 09. That is the time also when we saw almost a 30% drawdown. At that point of time, I think the difference I would point out during that time was consumer balance sheets were a lot more levered. Company balance sheets were a lot more levered. But we're seeing the opposite now. Consumers are a lot more are stronger, but companies also have a lot of wiggle room if you were to look at it from a leverage perspective.
Yeah, very good. And I've just got one more question I wrote down. Actually, a student text me this as you were going through it. In terms of core fixed income, could you elaborate on the term core fixed income? What it actually means?
Yeah, absolutely. Sorry about that. So core fixed income basically means that we're not looking to take any credit risk, right? So generally when you look at fixed income, you have rates. You have the fundamental rate that is being offered through think of it like the US 10-year curve. Or the US Treasury curve, like 2, 3, 4, 5 year, 10-year kind of, and then you have the credit spreads that sit on top of it. Right, we are saying that there is no point at this point of time. The reason for us to take credit risk is not so much. We can still remain with the core fixed income, which is just IG and the rate market itself to generate the kind of returns that we used to kind of. So there's no point in taking credit risk. Is the point that we're looking to make here.
All right. Well, look, there's a lot of questions we have to get through. Maybe if you could stop sharing your screen, Haresh, and then we can sort of look as though we're in conversation. The first question here, just wanting your views around the management, the government here in Singapore. What do you think of how the Singapore government has managed, what have been very tough economic times, in particular reference to their inflation, which I would add is the increases have been much lower than, say, New Zealand, which 7-8%.
Yeah, I would say, I mean, Singapore has obviously done as much as they could in terms of managing the situation. They're not very, I mean, as an economy, we are not very far off from the kind of issues that we have seen play out in the US, in Europe, or any place, right? We have also had impact because of supply chain disruptions. We had our own COVID strategy that has led to lower growth for multiple quarters. So I would say that they've been proactive in the sense that they've been trying to manage the situation with the best amount of with the best possible, hoping for the best possible outcome. But it's very difficult to say an economy which is so export and import dependent during the crisis. It becomes a lot more difficult for them to have a nuanced approach to and we've all gone through it. There can be very different degrees of impact, but I think all of us have, or most of the economy or economies in the world have gone through the same kind of challenges.
Yeah, No, it's really interesting, and just building on that, the Singapore situation. I was looking this morning at the news press release in New Zealand. They've just dipped into a negative GDP performance for the first quarter.
Yeah.
So one of the questions here is in reference to, what do you think we're destined for some kind of global recession? Something along the lines of a 2008 kind of crash. What are your thoughts on the future in that regard?
Yeah, yeah, absolutely front and center, right? This concern about recession. Funnily, post the or just before the FOMC meet happened yesterday, when the retail sales numbers came out in the US, Atlanta Fed came up with a GDP nowcast model, which basically mentioned that the Q2 GDP is going to be zero, right? So as I told you, the numbers are turning. The market is actually pricing in a lot of probability, or the probability of pricing in a recession has only gone up. We think that we can avoid a recession at this point of time, fundamentally because the consumers are strong and the company earnings are kind of holding up. But it would be I would say that the probabilities are going up as we speak, actually. Right.
Yeah, no, very good. There's so many questions coming through. I'm just trying to have them flow in some sort of logical order here. Another one, just in reference to recent news of tech growth companies laying off workers, Netflix, Shopee, Coin, etc. Does this mean the death of growth companies in this, for foreseeable future? Where should we put our focus in terms of investment? Should it be in value companies instead?
Yeah. So the way we look at it is, the pain is real, right? And it's kind of feeding through to employment and people getting laid off, as you rightly put it. But the way we look at it is, you have unprofitable tech companies where you don't have companies generating free cash flows. They are not profitable as yet. They're only concentrating on revenues and hoping that things will happen in the future. Their earnings will kind of get delivered in the future, and because of their business model, they were getting priced at very high multiples. We look at growth. We call it reasonably priced growth names. So what we like is having a good balance, as I mentioned to you. So think of companies like Microsoft, Apple, those kind of companies which are cash flow generating, who have a very stable business model, decent modes of businesses itself. Then also the large cap technology kind of companies are the places that you could kind of look at. So have a balance between both growth and value is the right way to probably look at this current cycle.
Yeah, and just thinking long term, as well. That's what I'm holding on to with some of those growth stocks. Just building on that, I've got some other questions around investments in gold, diamonds, high-end products, those kinds of metals, those things. Are they a solid investment in this, or even cash in the bank?
Cash in the bank, if you're kind of able to generate a decent fixed deposit, for example, place it at a higher rate, given that the rates are kind of going up. But always remember that when inflation is printing at 4 or 8%, and if your deposit is kind of giving you 2%, you're still getting a 6% erosion of your purchasing power, right? So that's something that you have to keep in mind. But luxury items, I'm not the right person to kind of comment on it, because see, my general sense on that is, I think a lot of people didn't have avenues to spend during the crisis. So all of this, like, the expensive watches and all of that kind of, went up. But now people are going for experiences than goods. So, be aware of that. The other point on gold, gold traditionally has been an inflation hedge. Especially when there is a lot of uncertainty. It is a risk aversion kind of a tool also. So there is a place for gold, and if you're able to kind of right size it, I think it kind of gives you that inflation hedge plus a risk aversion kind of mechanism as well.
And the next question, Haresh, it's not a webinar without a question that dips into the digital currency space.
Right.
So just a couple of questions around that. So what are your views around cryptocurrency? Will cryptocurrency be part of an institution's portfolio? I guess in some instances it might already be. And of that, is blockchain technology, especially the peer-to-peer payment, a threat to the legacy of, say, SWIFT or the IBAN modes of transfer?
But very, very interesting questions. And, blockchain as a technology, I think a lot of the question are kind of addressed blockchain as a technology rather than just the coins and the other things that we're seeing. As a technology, I think, even at JP Morgan, we've invested a lot of money in building out the blockchain technology. In fact, we work with Temasek and even the MAS to kind of build out the infrastructure for payments. It's an area that, as a technology, has tremendous amount of potential. We are looking at it, difficult to write it off. I mean, we're going through a tough time in terms of what you see with Bitcoin and Ethereum and all of that. But there's no denying that I think the blockchain as a technology is something that will stay, and the use cases will evolve as we go along. In payments and, probably the NFT and, all of the other trade related kind of use cases is something that's something that's interesting as well.
Yeah, good points, Haresh. I'm just looking at the time, just got a couple of minutes left. Just a question here around index investing.
Yes.
What are your views on sort of index investing? Is it the best sort of approach for someone who has, not much time or sort of knowledge in investing, but they're wanting to sort of, I guess, put their toes in the water?
Absolutely. I mean, the passive investing or index investing has become a big part of the market now. The last 10, 15 years, the amount of money that is in passive vehicles has only gone up. It is a nice way to kind of get the benefit of diversification and not take those individual company risks and all of that. As long as, my only sense on that is, as long as you're diversified enough and you're able to kind of take exposures across, say, probably different indices, but if you're keeping it broad based, then just the S&P 500 or the NASDAQ or any of these broad based indices will give you the amount of diversification that is needed. As long as you're able to right size it within your own personal portfolio, make sure that you have the right amount of allocation to equities, for example, in general. Think of your risk appetite more importantly, because that's how you're going to react to changes in the price of this. And when you're going through a tough year like this, it becomes a lot more important that you have put the right amount of money in the equity market or through these passive instruments.
Okay, and maybe time for just one more question here. There are other ones around investments decisions and stuff like that, but this one is, how can one monetize volatility? Directional option strategies on the VIX. I hope you understand what a VIX is.
Yes, VIX index. Yeah. Monetizing volatility, again, you're now moving into trading a lot because you are using, say, options or just buying into the levered ETFs and other things that are offered on the VIX. We generally kind of not go for it so much because it's the market itself can be a lot more volatile, and then you are having the volatility of the market as an instrument to trade it. My general sense is there's no point and there's no need to complicate it so much. We can keep it a bit more simple and try and look at underlying instruments like equity or even fixed income as a way to kind of create your portfolio and generate returns.
Okay. And last question, just something maybe for the people that are here today, just to go away with, would be what sector, or you don't have to give an individual stock or anything like that, but what might be a particular sector or area that you would encourage people to look into a little bit more moving forward over the next, say, 1 or 2 years? crystal ball gazing here, Haresh.
I mean, we cannot get away from technology, right? Like technology is like now an undercurrent, according to me. And that's how I look at it. It's no longer just a sector. It's an undercurrent that gets played out across different use cases, different sectors, different, industries. It's very difficult for you to take your mind off technology. So technology is something that we'll be definitely having a close watch on. And, communications and consumer discretionary also has an element of technology, right? Like, because your Netflix, Facebook, all of that are in communications, but your Amazons and others are in the consumer discretionary name. So technology is one space that, is probably, I would say, an undercurrent that you cannot ignore.
Okay.
You cannot ignore.
Yeah, look, thank you so much, Haresh, for that advice. And thank you so much for answering all the questions and for your very insightful presentation. It was really much appreciated. Just want to raise for all the people in the audience today, thank you so much for coming. I hope you've been able to take a lot of really insightful things away from the event. There's just a poll that's just come up now on your screens. And if you could just quickly complete the poll and the survey when you log out. So I guess having said that, I just finally like to thank Haresh again for his time. And for all those that have tuned in from all the different parts of the world. Thank you very much.
Thank
Have
you.
a good night. Thank you.
The pleasure is mine. Thank you so much. Thank you.
No worries. See ya. Bye-bye. Bye.